Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
You know, we're always trying to find research that really speaks to you, the practitioner scholar, and today we have a really crucial one. It tackles how fair value accounting standards actually connect with legal risk.
Which is a huge issue, right? Because fair value is everywhere in GAAP now.
Exactly. And this paper we're digging into, fair value accounting standards and securities litigation, it gets right at this core tension.
It's a fascinating tension. Does the high level of judgment fair value needs, does that open the door for lawsuits? You know, shareholders second-guessing management.
Or does the sheer complexity of it all actually shield companies?
Yeah.
Because, well, how do you prove someone intended to mislead when the rules themselves are so intricate?
That's the million-dollar question they're tackling, and it matters now more than ever. Think about asset impairment, derivatives, intangibles from M&A, ASC 360, 815. Fair value is deeply embedded.
And we know securities litigation isn't just, a nuisance cost. It's supposed to be a key way investors hold managers accountable. So does fair value help or hinder that? That's what we're unpacking today.
Yeah.
Okay, so let's lay out this study itself. The basic research question is pretty direct. How do fair value standards influence a firm's risk of getting hit with a securities lawsuit?
Right. And they looked at a massive amount of data, over 1,300 JAP-related class actions spanning, 1996 to 2017, a long window.
Yeah, a really comprehensive sample. And their key finding, it kind of flips the script on what you might expect.
It really does. They found that firms relying more on fair value standards are actually less likely to be sued, significantly so.
So, contrary to the idea that subjectivity breeds lawsuits, it seems fair value is, relatively speaking, a lower risk area within GAAP litigation.
Which is a major contribution. It's some of the first big systematic evidence on this link, moving beyond just thinking about fair value for, say, stock prices and into its role in governance and control.
And how do they measure this reliance? That seems key.
They developed a measure called FV reliance. It's based on textual analysis, basically counting how often keywords related to specific fair value standards pop up in firms' 10K filings.
Okay, textual analysis. Interesting approach.
Yeah, it captures how much a firm is actually engaging with and disclosing these standards over time. And for you, the practitioner, or maybe if you're involved in policy, this is super relevant.
How so?
Well, for standard setters, it suggests maybe the legal fallout from new fair value rules isn't as bad as, say, new rules based on historical cost. The litigation risk seems lower.
Okay, that's a big takeaway for FASB or the IASB.
Definitely. But for managers, the deeper question is about accountability. If fair value makes it harder for shareholders to successfully sue, does that weaken a key monitoring tool? That's a governance issue to chew on.
Absolutely. Okay, before we jump into the structured questions, there are a few key concepts we really need to nail down. The first one is central to their whole argument, scienter.
Scienter, yes. This is absolutely critical, especially after reforms back in '95. In securities fraud cases, under Rule 10b-5, plaintiffs don't just have to show a misstatement. They have to prove the managers knew it was wrong or were incredibly reckless about it.
They have to prove fraudulent intent, essentially.
Exactly. And that's where fair value's complexity comes in. If evaluation involves tons of assumptions, complex models, level 3 inputs, it's much easier for managers to argue, look, we made a judgment call in good faith based on a complex standard. It was an honest mistake, not fraud.
So complexity becomes a defense against proving that required state of mind.
Precisely. It raises the bar for plaintiffs enormously, potentially decreasing litigation risk. That's theory B in a nutshell.
Got it. Okay, concept number 2. The FV reliance measure itself, we touched on it, but how exactly did they quantify reliance from text?
Right. They used an approach building on prior work, scoring the relative impact of different standards based on keyword counts in the 10Ks. It gives a score that changes across firms and, importantly, over time.
So it picks up, for instance, when a major new fair value standard like SFAS 157 comes online.
Exactly. You'd see the measure generally increase then, reflecting wider adoption and disclosure. It's designed to capture that dynamic reliance.
Makes sense. Third concept, the volatility channel. This is the counter argument, right?
Yeah, this is the main reason you might expect fair value to increase litigation risk. We know fair value, especially for things like derivatives, can make reported earnings jump around a lot more. One study found it increased bank income volatility 5 times over.
And high volatility often leads to bigger stock price drops.
Right, and big stock drops are lawsuit magnets. Even if the alleged reason for the lawsuit isn't directly about fair value, maybe it's revenue recognition, a big drop increases the potential damages plaintiffs can claim, making a suit more attractive financially. So fair value could indirectly increase litigation risk through this channel.
Okay, so you have the complexity shield pushing risk down and the volatility trigger potentially pushing it up.
That's the core conflict they need to disentangle.
Last quick one. Big R restatements, AAERs. Why did they look at these specifically?
These are proxies for, let's say, detected accounting problems. Big R restatements are material corrections to past financial statements' serious errors. AAERs are SEC enforcement actions.
So actual confirmed instances of getting the accounting wrong, sometimes involving investigations.
Exactly. And crucially, these often imply some level of intent or serious negligence, similar to the scienter requirement in private lawsuits. So the authors checked if relying more on fair value was associated with a higher likelihood of these detected problems. It's another way to test if FV facilitates hidden manipulation.
All right, that sets the stage nicely. Let's dive into our structured questions. First up, what is the research question and why is it important? Seems simple, but let's reiterate.
The core question is crystal clear. What's the effect of using fair value accounting standards on a company's risk of facing securities litigation?
And the importance.
It stems from two key things we've touched on. One, fair value isn't niche anymore. It's woven deep into the fabric of GAAP, covering assets far beyond just traded stocks. Think valuing brands, we're testing goodwill for impairment.
So its reach is broad.
Very. And two, litigation serves as this external check on managers. It's a way shareholders hold them accountable. So understanding how a major shift in accounting measurement, like the move to fair value, interacts with this legal check is fundamentally important for governance. It answers that call to understand how fair value impacts the legal system.
Okay, that makes sense. Now let's get into the theoretical tug-of-war. What theories do the authors rely upon to develop their hypotheses? You mentioned two competing channels.
Right. And because these channels push in opposite directions, they actually start with a null hypothesis predicting no overall effect, basically.
So theory A, the one predicting more risk.
Theory A leans heavily on the subjectivity and discretion inherent in fair value, especially for those harder to value level 2 and level 3 assets. Think about valuing private equity investments or complex derivatives. Managers have leeway in choosing models, inputs, assumptions.
And the argument is shareholders can challenge those choices after the fact.
Exactly. If things go south, plaintiffs can allege managers cherry-picked inputs, used overly optimistic models, or delayed writing down assets to manage earnings. It's the second-guessing argument discretion invites litigation. That was the worry expressed in earlier commentaries.
Okay, that's the increased risk path. What about theory B, the decreased risk path?
Theory B flips it and focuses on complexity and, crucially, that scienter hurdle we discussed. The argument is that the complexity isn't just in the assets being valued, but in the accounting standards themselves. SFAS 157, for example, is dense.
36 pages of guidance you mentioned.
Yeah. So when plaintiffs try to build a case, they face a huge challenge, proving that management didn't just make an honest mistake navigating this complex guidance, but actually intended to deceive.
Even if there's a restatement.
Even then. Previous research suggests complexity provides cover. Managers can argue it was an error in judgment within a complex system, not deliberate fraud. That difficulty in proving scienter acts as a powerful shield, potentially lowering litigation risk.
This really highlights the importance of their research design. They need to isolate these effects. So how does the research design address validity construct, internal, statistical conclusion, external, as well as potential issues like non-random assignment and exogeneity? This is where the rubber meets the road for trusting the results.
Absolutely. They were very thoughtful here. Let's start with construct validity, basically. Are they measuring what they think they're measuring? That FV Alliance textual measure is key.
And we already flagged a potential concern using text counts instead of maybe balance sheet amounts.
Right. And you raised a good point. Does relying on disclosure capture the real reliance? Their defense is that it captures the implementation complexity and engagement, which varies even for firms with similar balance sheet exposures.
But they did test alternatives.
Critically, yes. They ran the main analysis using two other measures. FVBS, which is that balance sheet exposure you mentioned scaled by assets, and FV reliance count, a simpler count of FV standards mentioned.
And the results held.
The core finding the negative relationship between FV reliance and litigation was consistent across all three measures. That provides a lot more confidence in the construct validity. It's not just an artifact of one specific measurement choice.
Okay, that's reassuring. What about internal validity? controlling for other factors that might drive litigation.
They threw in a whole battery of controls standard in litigation research, things like firm size, profitability, stock return volatility, trading volume, whether the firm issued new securities, the usual suspects.
Based on prior work identifying litigation determinants.
Exactly. But they also included crucial accounting-specific controls. They controlled for reliance on non-fair value standards, non-F reliance, overall accounting complexity using other measures, and whether standards were more rules-based, plus industry and year-fixed effects.
So they're trying hard to isolate the unique effect of fair value reliance, separate from just being a large, complex firm using lots of different accounting standards.
Precisely. That separation is key to their claim.
And how do they handle that potential endogeneity or confounding effect of the volatility channel? You can't just control for volatility if that's part of the mechanism you want to study.
Right, that's a classic issue. If you just stick volatility in as a control variable on the right-hand side, you might accidentally remove the very indirect effect you're interested in.
So what do they do instead?
They used path analysis. Instead of just controlling for volatility, they explicitly modeled it as a mediator, a variable that sits in between fair value reliance and litigation risk. This lets them estimate both the direct effect of FV reliance and the indirect effect that works through volatility. That leads us right into the econometrics.
Okay, let's get technical, but keep it accessible. What econometric methods are employed, and how do they address weaknesses in the design? What was the workhorse model?
For the main analysis predicting the probability of being sued, SUED1, based on FV reliance and controls, they used logistic regression. That's standard when your outcome variable is binary, like yes-no for a lawsuit.
Makes sense. And for testing those intermediate links, like the effect on volatility or restatements?
For the volatility link, earnVol, which is a continuous variable, they use standard OLS regression. For the likelihood of restatements or AARs, which are also binary, they use logistic regression again.
But the really clever part, as you mentioned, was the path analysis. Can you unpack how that specifically helped address the design weaknesses, like separating the competing channels?
Yeah, path analysis was crucial. It essentially involves running a system of simultaneous regression equations. It lets you estimate different causal pathways at the same time.
So path 1 is FV reliance directly impacting litigation risk.
Right, that's the hypothesized negative effect, the complexity shield. Path 2 is FV reliance impacting earnings volatility, and then earnings volatility impacting litigation risk. That's the hypothesized positive indirect effect.
And path analysis gives you coefficients, or weights, for each path.
Exactly. It quantifies the strength and direction of both the direct path, FV litigation, and the indirect path, FV volatility litigation. By comparing the size of these path coefficients, they could determine which effect dominates. Is the negative shield stronger than the positive volatility trigger?
So it moves beyond just saying both effects might exist to actually measuring their relative importance. That's powerful.
It really is. It allows them to test the net effect while acknowledging and quantifying the counteracting force, strengthening their overall conclusion.
Okay, crunch time. Let's talk results. What are the major results? And to answer the research question, what did that main logistic regression show?
The main finding, as we hinted, was statistically significant and negative. Higher FV reliance is associated with a lower probability of being sued.
How much lower? What's the economic significance?
It's pretty substantial. A 1 standard deviation increase in their FV reliance measure was linked to a 0.49 percentage point decrease in the likelihood of being sued in a given year.
Okay, 0.49 points. How big is that relative to the average risk?
The average firm in their sample had about a 2% chance of being sued.
Yeah.
So that 0.49 point reduction is about a 24.5% decrease relative to the average risk. That's a big drop.
Wow, nearly a quarter reduction in risk. That's not trivial at all. And you mentioned earlier this was driven by settled cases.
Yes, they split the sample. The negative effect was strong and significant for cases that settled, the ones usually seen as having more merit and posing a real financial threat. But it wasn't significant for cases that were dismissed.
That suggests the shield is most effective against the lawsuits managers probably worry about most.
Seems that way. Now, what about the channels? Did they find evidence for that positive volatility channel?
Did FV reliance actually link to higher earnings volatility?
Yes, they found a significant positive association there using OLS. So more fair value reliance does lead to jumpier earnings, confirming that part of the mechanism exists.
Okay, so the trigger is real. But did the path analysis show it mattered much for the overall litigation risk?
This is where the path analysis really shines. It showed that while the indirect effect through volatility was positive, increasing risk slightly, its magnitude was tiny. We're talking about an increase of only about 0.005 percentage points relative to the mean.
Okay, wait. The negative direct effect reduced risk by almost 0.5 percentage points, and the positive indirect effect increased it by only 0.005.
Exactly. The direct negative effect, the complexity shield, absolutely swamps the indirect positive effect from volatility. The net effect remains strongly negative.
So the volatility channel is real, but economically almost irrelevant compared to the protective effect of complexity.
Pretty much. And one final piece, the fraud misstatement channels. Did they find FV reliance linked to more big R restatements or AAERs?
Were firms using FV actually getting caught cooking the books more often?
Nope. They found no significant association between FV reliance and the likelihood of either of those detected misstatement events.
So the discretion inherent in FE doesn't seem to translate into a higher rate of detected material errors or enforcement actions.
At least based on this analysis, no. So putting it all together, does it answer the research question? Yes, emphatically. The results consistently show that, on balance, relying more on fair value standards is associated with lower securities litigation risk, primarily because the complexity makes proving scienter very difficult.
Okay, that's a clear set of findings.
Yeah.
Let's move to the final structured question. What conclusions do the authors make, and are they warranted given the theory, design, and econometrics?
Their main conclusion is pretty straightforward. Fair value accounting, despite its subjectivity, appears to be a relatively low litigation risk area within GAAP overall.
And is that warranted?
I'd say yes, definitely. The core negative finding is robust. It holds up using different ways to measure FE reliance. It holds up after controlling for a wide range of other factors, and the effect is concentrated in the costly settled cases. The path analysis also convincingly shows the counteracting volatility effect is minor. It strongly supports the theory that complexity shields firms by making scienter hard to prove.
What about their second main conclusion regarding new standards?
Right. They also looked at the change in litigation risk around the time new standards are adopted. They found that, yes, adopting any new standard tends to temporarily increase litigation risk, probably due to implementation issues or confusion.
But there was a difference between FE and non-FE standards.
A big difference. The short-term spike in litigation risk associated with adopting a new fair value standard was about 75% smaller than the spike associated with adopting a new non-fair value standard.
That's a huge gap. So for standard setters worried about litigation impacts,
the implication is that, from a pure litigation risk perspective, adopting new fair value standards seems less disruptive than adopting new standards based on, say, historical cost or specific bright-line rules.
is that conclusion warranted too?
I think so. Again, it flows directly from the consistent negative finding for FV reliance overall and the careful way they isolated the FV effect. The design and econometrics seem solid enough to support both conclusions. The complexity shield is real, dominant, and it even seems to cushion the blow when new FV standards are introduced.
So thinking about the bigger picture, this paper really connects to that broader literature on complexity in accounting, doesn't it? The idea that complexity can sometimes shield firms isn't entirely new, but applying it so directly to fair value is significant.
Absolutely. It shifts the conversation about fair value away from just, is this measurement relevant for valuation, towards how does this measurement approach impact managerial accountability and control? The findings suggest that the very nature of principles-based subjective standards like fair value might inherently weaken one of the key external governance mechanisms we rely on: litigation.
Which brings us to that final provocative thought for you, our listener. If this research holds, and fair value standards do indeed lower the threat of costly lawsuits, what does that mean for ensuring managers act as good stewards?
Yeah, the authors themselves raise this point. As GAAP continues to incorporate more fair value measurement, which seems to be the trend, does this unintentionally make it harder for shareholders to hold managers accountable through the courts? Are we gaining measurement relevance at the cost of enforceability?
You'd suggest that if the external legal threat is weaker in these complex areas, maybe the burden shifts. More reliance might need to be placed on internal governance, board oversight, maybe internal audit functions to monitor those subjective judgments where litigation fears to tread.
That's a critical implication. How does your own firm handle this? Think about your exposure to level 2 and level 3 fair value estimates. If it's high, this paper suggests your litigation risk might be lower than peers using simpler accounting.
But does that lower external risk come with a greater internal responsibility to ensure those complex estimates are robust and made in good faith? Something important to consider.
Definitely something to mull over.
And that concludes our deep dive on fair value accounting and its surprising relationship with litigation risk. We hope this breakdown helps you navigate these complex waters.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.